Okie dokie. Okie dokie, everyone. First of all, can I say either a good morning, good afternoon, or even a good evening, depending on where you are around the world. And thank you for joining me tonight on the latest episode of Discover Trading webinar series, written by myself, which of course James Alexander, who is the Chief Market Analyst here at Wise Bank. Tonight's episode is called Discover Why Fundamental Analysis Matters in Trading. But before I begin on an introduction on myself and obviously tonight's agenda, like I say, obviously we'll have the question and answer session at the end. But can I just say a very good morning to Henry, who's already said good morning to me on the chat window. So good morning, Henry, and welcome. Now, this sultry individual is myself. Like I said, my name is James Alexander. I'm the Chief Market Analyst here at Wise Bank. I have over 20 years experience in the financial service industry. I actually started off as a mortgage broker, believe it or not, in the UK. As you can tell by my accent, I'm indeed a Brit. I then, after mortgages, actually where I specialize in commercial mortgages, buy-to-let investments and things of that nature, I moved into pensions. Henry, you cannot hear me. Can everybody else hear me okay? You turned your volume up, okay? Can everybody else hear me? Everybody else hear me okay? Everybody else hear me all right? Can you hear me now, though? Can you hear me okay now? Yeah? Can everybody else hear me? Can they just say something on chat? The other individuals who are here? Can everybody hear me now? Can you hear me now? Can you hear me now? Anybody hear me now? Everybody hear me okay? Yes or no? Everybody hear me okay now? See, my mic is working. Anyone? Yes, excellent. Okay, we're back in the game. All right, let's start it. Let's carry on then. Right, like I say, okay, I was a published writer in many leading industry publications, including the likes of the Financial Times Advisor, Market Watch, The Street, and several magazines and newspapers. I'm also a very passionate, brilliant, Henry, that's good news. I'm glad you can hear me now. Okay, I'm very passionate about this industry. Okay, very passionate about this industry. And I've also been well known as a very avid market commentator. I do comment a lot about how I see the market and how I see things going. I'm also a well-known public speaker, and I've spoken at several industry events around the world, including like Kuwait, the Emirates, Saudi Arabia, Lebanon, Hong Kong, London, of course, and Germany, etc., etc. Now, tonight's agenda, like I say, is about fundamental analysis. And it's something I'm very passionate about because when I started off trading, I actually started trading gold. And this is back in the day when gold was trading around about $686 an ounce. So back then, back in the day, gold was very much fundamentally based. So we used to look at a lot of fundamentals, not so much technicals back then. So this is why I'm very passionate about fundamentals, and I'm very passionate about trying to explain why fundamentals matter and why certain things people should pay attention to and understand why this has an impact on the market and etc. So after what introduction to what fundamental analysis is, we'll discuss obviously economic indicators, which is all part of fundamental analysis. Then we'll discuss the economic indicators' effect on the market, why they can actually impact the market the way they do. Then we'll talk a little bit about brick exit. And then I'll do a question and answer session at the end. So what is fundamental analysis? Fundamental analysis is the study of macroeconomic effects that can affect economies, stocks, forex, commodities, and of course, companies. Traders use fundamental analysis to try and forecast future price movements. Now, there is an argument that you're either a fundamental analysis trader or a technical analysis trader. In my opinion, the best type of trader, it takes into account everything: fundamentals, technicals, price action, but also sentiment, market sentiment, and basically what the buyers are doing. But there is an argument between the two, and there's a big difference between a fundamental analysis trader and a technical analysis trader. And this is as follows. Fundamental analysis trader, what they do, and this is the method, is they try to identify the actual intrinsic value of an asset, what an asset is actually worth. Fundamental analysis, they study the overall picture, okay, by taking into account economic data, industrial data, and financial conditions. So they spend a lot of time looking into reports, data, and things of this nature to try and find out what the actual value of an asset actually is. Whereas a technical analysis trader, they assume that the fundamentals are already factored into the value of an asset, so they ignore the intrinsic value altogether. Instead, technical analysis traders, they attempt to recognize patterns and trends and to try and predict future moments that way. But like I say, with fundamental analysis, and this is why it matters, it's the intrinsic value of what something is actually worth. And this is why I personally believe people should pay more attention to it. At the same time, with fundamental analysis, especially with economic indicators, which we're going to talk about now, these can cause spikes and movements in the market. Now, economic indicators are basically reports and data to try and show what is happening. And in this reference to this, I'm talking about currency pairs. I'm talking about Forex, okay? Economic indicators are reports and data and statistics which tries to underline or indicate how healthy a country's economy is. What is, what's moving. And these sort of indicators include the likes of the following, like consumer price index, employment figures like the non-farm payroll, retail sales. Now, don't forget, we live in a modern day world now where basically our economies are driven by how much money we spend. Okay, how much new iPhones we're buying, how much new DVDs. Oh God, I'm sounding old. DVDs is Netflix now, James. Come on, get with the times. Not DVDs, sorry. How many phones and cars and T-shirts and things like that people are buying. Because obviously we're buying and spending more, then they're bigger, making more, and so on and so on. So retail sales comes into effect a lot. Industrial production. Obviously, if we're making a lot of things in this industries on the rise, that can have an impact. producer price index, which is an inflation indicator, gross domestic product, which is basically the overall health of a country's economy, which we'll talk a lot more about in a bit, and like interest rate decisions. Why interest rate decisions moves the currency market. Now, I'll break down a couple of these and go into a little bit more detail so there's a bit more of an understanding about why they matter. Now, here's the question. Again, I'm talking in relation to currencies, okay? What makes one currency stronger than the other? Good question, right? Because all currencies are made out of the same material. Okay? Made out of the same material. They're all made out of paper. They're all made, coins are made out of the same type of metal. But what makes one currency valued more than the other currency? And this is how it basically breaks down, is a strong economy equals a strong currency. So these economic indicators, the reason why the market watches it is to indicate how strong that country's economy is, because that strength or weakness in that economy can make that currency stronger or weaker. Don't worry, Henry, I'll answer your questions at the end, my friend. Don't worry, I'll answer all your questions at the end. Now, here's some of the indicators on why they're important, okay, and why they can impact the market. So let's start off with Consumer Price Index. What is the Consumer Price Index? Now, the Consumer Price Index is basically a key indication of inflation. It's released on a monthly basis, and it's a percentage. And like I say, it measures the change in price of a basket of goods and services. And it is the key indicator for measuring inflation. Now, how this moves the market, or potentially moves the market, is that the higher the percentage, the higher the chances of a central bank raising interest rates. The lower the percentage, the lower the chances of that central bank raising interest rates. That sounds nice, James, but what does that actually mean? To give a bit of explanation, let me explain. I'll give the UK. Obviously, I'm a Brit, so I know the UK. Let me give the UK, what's happening in the UK, more of, tell you, a little bit about what's happening with inflation in the UK and how that moves the currency market, okay? Now, obviously, since 2016, when the Brits, or some of the Brits, voted to leave the European Union, the British pound collapsed against all its peers, the euro, the US dollar. Now, UK, as we all know, is an island. So it has to import a lot of its goods in from Europe. Because the currency, the British pound, had collapsed quite a bit against the euro, it meant it was more expensive to get these goods and services into the UK. So it stopped costing the common person, or the everyday man or woman, more to buy things. That increased inflation. Now, to battle inflation, like I've already said in this slide, the Bank of England had to raise interest rates. And when they raised interest rates, it can give strength to the currency. It made the British pound bounce back up against, not a lot, but a bit, up against the euro and the US dollar. So when the CPI is high, the market watches it and see if they see a high number, they start double guessing that the central bank will raise interest rates. And if they do, it can potentially make that currency stronger. If the CPI or inflation comes in lower, then the market looks at it and thinks, no, they're not going to raise interest rates. So the currency gets weaker. So this is how it impacts on the currency market and why it's a key indicator to watch. Retail sales. Again, this is a monthly report. Okay, it is indeed a percentage. And retail sales measures the sale of goods from the retail sector, basically how much money we are spending on goods. If there is growth in retail sales, it indicates that the economy is growing alongside consumer confidence. A higher number could lead to a stronger currency, whereas a weaker number could lead to a weaker currency. Why is that? Well, again, like I say, the modern day economy is based on us spending our money. So if the retail sales percentage is high, it's showing that the everyday man and woman is confident. We're out there spending our money. We've got spare money in our pockets. We can buy new iPhones, buy new cars, buy new jumpers, buy new hats. So the economy is stronger, and that can push the currency higher. If there's a slowdown in retail sales, if people aren't spending their money, then it goes to show that A, people are nervous. We haven't got as much spare cash as we have. And so the economy is potentially getting weaker, and that can weaken the currency. Gross domestic product. Again, this is released monthly. It is a percentage, and it measures the overall health of a country. The higher percentage shows the strength of that country's economy, which can potentially lead to a stronger currency. The weaker that GDP number is, could lead to a weaker currency. So this is why gross domestic product has an impact. It measures the overall growth of that country's economy. If it's growing, then that currency should potentially get stronger. If it's decreasing or struggling, then the opposite effect can happen to that currency. Non-farm payroll. Now, this is released monthly. It is a number, okay? And it's usually released on the first Friday of every month. Now, this is US data, okay? So this affects the US dollar, okay? And it basically measures the total of new jobs created and taken on from the previous month, not including farm workers, hence the title non-farm payroll. Now, this can cause a lot of volatility in the market, extreme volatility in the market, and it can affect the dollar against the majority of the majors, like the euro, like the pound, like gold, etc. And it's, it can, depending on your attitude to risk, could be a good event to trade. If you're risk adverse, maybe not such a great event to trade. Okay. Now, obviously, the higher the number leads to a stronger, potentially stronger US dollar. The weaker the job number could lead to a weaker US dollar. And again, this makes sense. If there's more jobs being made, if there's more jobs being taken on, again, that economy is growing stronger. If there's less jobs being created, less jobs taken on, means that economy is weakening, hence leading to both a potential strong currency or a weak currency. This all leads up to interest rate decisions. Okay, interest rate decisions. Now, this, of course, is depending on the central bank. This is released or decided upon around about 8 times a year. Again, it's a percentage. And there's 2 expressions or 2 things you need to understand when relating to interest rates. Okay. Now, when inflation is high and the economy is growing, the central bank in question increases interest rates to encourage us to save and attempt to lower inflation. Why? Because obviously if the interest rates are higher, we're going to be more likely save our money and borrow less because it's more expensive, and it potentially makes that currency stronger, which can then lower inflation. When things are not so good, when inflation is low and the economy is stagnant or struggling, the central bank in question will lower interest rates to instead encourage us to save our money, encourage us to borrow and spend to try and reboost and rebuild that economy. Basically, exactly what happened back in 2008, 2009 with the credit crisis, okay, with the financial crisis. Central banks around the world realized they were in serious trouble They lowered interest rates to record lows to encourage us as the consumer, but also businesses and things like that to borrow money so we can re-inject life into an economy, reboost the global economy. Okay, that's what they did. And this is why only now we're seeing some central banks increase interest rates, like the United States, like Canada, like the UK has done twice. Okay, so this is all important because if they tighten, things are good. If they loosen, things are not so good. So tightening, potentially good for the currency in question. Loosening, pretty much not so good economy, so potentially weaker for that currency. As well as that, there's another factor in play which has an impact on the currency. That obviously, if we have higher interest rates, or a country has higher interest rates, then what happens there? It interests foreign investors, okay, to invest in that country because obviously they're getting more money for their more bang for their buck because interest rates are better. So it also encourages foreign investment as well. And that's what can also strengthen the economy, but also strengthen that currency as well. There's other things. It's not just economic indicators, okay, which has a big impact on the currency market. You also have the likes of press conferences and minutes. Now, the market monitors press conferences and minutes released by central banks to try and read into when they may raise or lower interest rates in the future. And this is where you hear two expressions, is market expression. If the speaker is hawkish, the currency could get stronger. If the speaker is dovish, then the currency could get weaker. That sounds really exciting, James, but what does that actually mean? Right. When a speaker is hawkish, what they mean by hawkish is that he's aggressive in his statements or her statements. They're aggressive in what they say. They're optimistic. They hint at potential reducing, maybe, I don't know, a quantitative easing, or discuss maybe raising interest rates. They're optimistic. They're aggressive in their statements. They're called hawkish because obviously the hawk is an aggressive bird, predatory bird. So when they're hawkish, it can have a positive impact on that currency. If the speaker is dovish, what dovish means is they're slightly more nervous in the way they speak. They're slightly more pessimistic about their outlook. They slightly maybe drop hints of reducing interest rates or continuing QA. Okay, they're sheepish, they're more nervous, they're gentler in their statements. And they're called dovish, of course, because apparently doves are very gentle birds. Very imaginative, the people who come up with these names, I know. But yeah, that's what they mean by dovish. So press conferences and central banks like this do have a big impact on the market. Again, because it's giving hints of what they might do in the future or not do in the future. So the market looks at these sort of things to try and see the intrinsic value of a currency in the future. And this is why it moves the market. Now, key central banks to watch include the likes of the FOMC, okay, which is the Fed, the central bank of the United States. The ECB, Mario Draghi, for example, he's the key speaker for the European Central Bank at the moment till he steps down. And then, of course, you have the Bank of England, Mark Carney, who's the governor of the Bank of England. So when these three banks speak, they can have a big impact on the market. Now, to follow these events, okay, you can obviously look at the financial or economic calendar. I do suggest, again, it's an idea. It's not here for me to tell you how to trade. You need to find your own way, but trust me, this helps. I do like, and I do encourage people to, every day when they're thinking of trading, have a look at what is coming up on the financial calendar, what is due, and what could potentially move the market. And let me tell you a story, okay, why this is important, all right? Now, when I had one of my clients in my portfolio, okay, he was a trader, obviously, but he was more of a technical analysis trader, and he didn't really pay attention a lot to the financial calendar or the fundamentals. he basically based it on technicals. Fair enough. It worked for him sometimes. So, I'm not here to tell him how to trade, whatever works for him. Anyway, he was trading the British pound against the Japanese yen. And he had a good number of positions in the market. Because I know what's going on, because I follow the calendar, I know what events and what the story is behind the market at the time. I contacted him to let him know that his positions all were in profit. He was doing very well. And I called him up and said, look, just so you know, in about 25 minutes' time, Melvin, I think King was the governor at the time, he will be speaking in 25 minutes' time about the UK inflation report. You have sterling positions. He could impact the market. So you might want to either lock in some profit or take in some profit and maybe step out and see what happens after this gentleman has spoken. Okay. And he said, his name was Brian. And he went, no, James, it's all right. I know what I'm doing. Don't worry about it. I'm fully in control. I know what I'm doing. I went, fair enough, Brian. Not my trades. I'm just here to keep you informed. And, so I left him to it. 28 minutes later, after the speech or the inflation report comes out, he calls me up asking me what the hell has happened. All his positive positions are now to negative. And he's asking me, what's happened? What happened? And I said, Brian, I told you there was the UK inflation report. If you read it, he's very negative, or has a negative outlook on the UK's current economic performance. So he's dovish. And this is why he's made the pound weaker. And he ended up losing, not profitable trades. He ended up being in a negative. So it did impact the market on that. So this is why I say it's always a good idea to understand what's happening in the financial calendar. One, depending on your attitude to risk, you might want to trade that risk event. Or two, if you have positions in the market, you might want to step out and wait to see what happens after that event. So the financial calendar is really keen to keep an eye on. And obviously market news and things like that, breaking headlines, certain things like supply demand reports. All these are the sort of important events you need to follow and be aware of if indeed you want to pay and trade with fundamentals. Right, up and coming educational events. On the 6th of December, I'm doing Discover Price Action, which is more technical based, but not really technical because I'll be talking about a type of trading where you trade naked. I'm not talking about trading in front of your laptop or computer with no clothes on. But then again, I'm not here to tell you how you live your life. I'm talking about basically trading with very little indicators on your charts and how you can really look for sort of patterns where the buyers and sellers are. So that's Discover Price Action Part 1 on the 6th of December. Then on the 20th of December, I will be doing one called Discover WTI Oil and Brent Oil. It's actually been a request by one of you fine people who have asked me to do a webinar on that. It's actually a case study on oil and Brent oil. And then wrapping up the month, because we're going to be doing 3 episodes in December, I will be doing Discover RSI and other oscillators. So again, that would be very technical analysis based webinar. If you wish to reach out and talk to me, by all means, you can email me at james.t@wisebank.com, or you can follow me on my Twitter, which is at JamesAlexanderT. And what you'll see on my Twitter is a new Twitter account I've just opened and just started. But on this account, I do sort of share a few levels I'm seeing or developments I see in the market every now and then, plus market commentary. But at the same time, you can direct message me and talk to me on that if you want to as well. Now, so that's my Twitter account. On that note, let's go to any questions. Anybody got any questions on what I've discussed tonight? Henry, I believe you had a question. Going back to your question. Fundamental analysis. Holistical approach. Okay, thank you. I'm glad you enjoyed it. Okay, your question is the market behind it, Henry. What do you mean? Can you tell me a little bit about what you mean by that question? Is the market behind it? What do you mean? Is the market behind fundamentals? Is that what you mean? Well, don't forget, fundamentals are often economic data and statistics often set up by government agencies or private agencies. Okay, they're not related to market trading or anything like that. But the market's not the economy. Well, no, absolutely. A market can lead to a strong economy. But don't forget, it's the economy when, as I'm talking about fundamentals in relation to currencies, it's the economy which can grow and make the currency stronger. I mean, for example, the stock market in the United States at the moment, it's on a really big bull run. Okay. But because it's on a bull run, it's also given a lot of strength to the US dollar in many ways, but it's not the whole factor behind the strength of the US dollar. The whole factor of the US dollar is obviously the economy itself in the US is performing quite well. That's why they raise interest rates. So the market can play a part, but the economy, realistically speaking, is basically GDP, what we're spending our money on, interest rates, inflation, and things like that. Okay. Stock market crashes, of course, which can lead to weakening economies, does have that sort of impact as well. But, because it has a knock-on side effect. And indeed, the market actually tends to benefit more from a strong economy. So it's not like the market equals the economy, it's like a strong economy equals a strong market. Because that makes sense if you think about it. Okay. If the economy is strong, guess what? We have more money to spend and invest, don't we? At the same time, if the economy is strong and we're optimistic, we'll spend more of our money on riskier assets like stocks, like shares. Okay, they're far riskier. If the economy is weak and we're nervous, what we do instead as traders is we move our money into safe havens to protect ourselves, like gold, Swiss franc, Japanese yen. So a strong economy equals a better market, not the other way around. Any other questions? It's a good question, Henry. Thank you. I like it. It's a good question. Any other questions at all? Anyone? Okay, well, Henry enjoyed it. I'm glad you enjoyed it, Henry. I hope you come to the next episodes. And that's okay. Well, next time, I guess you can ask me questions and chat. But I hope you join next time, Henry. Did everybody else enjoy it or find it useful? Just put in the chat and go, yes, I did, or no, I didn't, or can you talk slower, or change your accent? It's too annoying. Okay, well, if there's other questions, Henry, you can always email me if you like. Or like I say, follow me on Twitter and direct message me on Twitter if you like. That's, if you want to do it that way. Like I say, that's my email address, my Twitter. God, I should put my teeth in. I don't have false teeth, by the way. I have perfectly healthy teeth. Well, most of them for a 4-year-old. Or follow me on Twitter at James Alexander T and direct message me that way. Anybody would like to make any suggestions maybe in the future for any future topics? Anything else you'd like me to maybe cover in the future at all? No? No? Next time. Okie doke. Well, look, in that case, these are my contact details. You think of any questions or any topics you'd like me to cover in the future, any areas you'd like me to go, maybe we can have a look at this, please feel free to contact me. But what I will say is thank you so much, everyone, for joining me tonight. Special shout out to Henry. Henry, you've been brilliant. Okay, thank you so much. I love interaction. I love questions on these things. Okay, I love questions on these things because otherwise it gets a bit lonely. It's just me talking to myself, so it gets lonely. So I like the interaction. So special shout out to Henry. So thank you for that. On that note, can I wish every single one of you either a good morning or good afternoon or even a good evening, depending on where you are around the world Till next time, have a fantastic day, and every single one of you, trade safe.